Well, when it comes to manufacturing, that's an export-oriented industry. It's benefited from two factors for the last 18 months. That is the weaker sterling after the Brexit mistake vote and the stronger global cyclical dynamics. Now, both of those factors are fading. The good news is for the UK for the next 2 years, it won't be manufacturing that is likely to drive growth. It will be stronger consumers. Consumers have been weak since the Brexit vote. Luckily, we've rotated towards manufacturing. Now we're going the other way. So I'm expecting growth, so long as we avoid a hard Brexit, to get back to around the 1.8% range for the next couple of years. That will be driven by stronger real incomes growth and continued employment growth, so largely consumer driven. For the Bank of England, they care about domestic factors. If the consumer is strong, that should be enough for them to continue a gradual normalisation.
I'm just looking at some of the job creation numbers here. It looks like the UK manufacturing job creation slowed to near stagnation. New export orders contracting for the first time in over 2 years. This is going to be a difficult political sell in the last few months ahead of that March 2019 Brexit deadline. These kind of numbers making it difficult for the government to say there's positive movement there.
Well, part of the problem is the way we look at trade negotiations in a way where we're importing the Trump disease, which is to look at trade as something that benefits producers, not something that benefits consumers. The benefits from trade come from what you import, not from what you export. What you export, that's the stuff you don't want. The UK, in pursuing Brexit and its non-EU ambitions, should be looking for ways to make goods cheaper for consumers, not boosting the bottom line for producers. So if the Brexit negotiations are approached properly, a weak manufacturing outlook shouldn't really matter much.
So you see that as the really difficult divide there between, say, the business lobby that, of course, wants to focus on exports and success, and then British consumers, voters, who perhaps like the idea of cheaper goods.
70% of UK GDP is consumption, 30% is exports. I would focus on the bit that is twice as big when I conduct my trade negotiations.
And of course the weaker currency plays into that as well. Looking at the currency here, how much of, I mean, it's very difficult to tell with these things, but how much risk premium is priced into cable at this point in time? What would you say is priced in terms of probability of a hard Brexit versus a Chequers type deal being agreed?
So I see the risk of a hard Brexit at around 20%. When I look at sterling, I think it's priced in more downside risk than it is upside risk when it comes to Brexit. The reason I say that is because economic fundamentals have changed in the UK and the currency hasn't followed. What do I mean by that? First, sterling sold off after the Brexit vote. The market concluded that Brexit would reduce long-term growth outlook and put the UK Bank of England in a dovish policy stance. Those two things happened then. The economy did better than expected. The Bank of England begins to tighten. By itself, that should be enough to push a currency up. That it didn't means there is some risk weighing on the currency. So my best guess would be we get a soft, semi-soft Brexit, a trade deal in goods, say a 60% chance, and we get cable at 145 by mid-2019.
What changes that 20% number for you out of interest? Because of course over the weekend we've heard from Michel Barnier saying, I don't like the plan that Theresa May has put forward. We've had former ministers heavily criticising this approach. As we get closer and closer to that, as more and more members of Parliament publicly say, I don't like the way the PM's taking this, especially members of our own party, senior members, does that 20% number increase? Has it increased over this weekend, for instance?
No, I don't think it's increased. I don't see how we can logically get to a hard Brexit scenario.
Even if there's a leadership challenge?
Well, here's the thing. The UK now has a choice between a hard Brexit, a free trade agreement, a customs union, or a Norway-style agreement. It's now Theresa May's job to try and sell that to Parliament. If her party do not back her on, say, a customs union arrangement, which is the minimum that is required to keep the Irish border open, what interest do the DUP, with whom the Conservatives are in alliance, have in remaining in government? That would indeed close the Irish border in a hard Brexit. So I don't think if the UK heads towards a hard Brexit, how the current government can sustain itself, how it can remain potent, i.e. can it have enough votes to get regular policy over the line, which means that if the Conservatives are really worried about Corbyn, and so far he has been the glue that binds both the Remainers and the Brexiteers together, what they will do is muster enough votes between themselves, try and get some cross-party support and go for a customs union deal. Otherwise they risk either a soft or a reversal of Brexit after fresh elections.
You essentially see Theresa May as caught between a rock and a hard place between the DUP and members of her own party who are incredibly opposed to the idea of customs union.
And then I would add to that the Corbyn risk. If Jeremy Corbyn becomes Prime Minister, If I look at the polls today, I don't see a large chance that he could become Prime Minister with a majority for Labour. He would have to go into some coalition either with the Lib Dems or the SNP. Those are the most pro-EU factions of UK Parliament. Under what conditions would I, as a Lib Dem, jump in bed with Jeremy Corbyn? Go for a Norway-style agreement, a soft Brexit, or maybe a fresh referendum. So Corbyn may even be forced to take a softer stance if he is in government. If the Conservatives look at that logic, they may indeed be inclined to go for a customs union and then ex post try and renegotiate.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.